This is not financial or investment advice. The information provided is for educational and entertainment purposes only. Please always do your own research and consult with a licensed financial advisor before making any investment decisions. Thank you, guys.
Hello, everybody. Welcome back. And today we're going to be going over how to structure a real estate deal with as little money as possible. And this is almost a follow-up to the video that I made titled How to Start Investing. In that video, just to briefly go through it, give you guys the recap, I talked about how you should really be saving and dollar cost averaging into something like the S&P 500 or maybe a high yield saving account until you get around $15,000. And I'm going to go into why you want to do $15,000 in a little bit. But this teaches you good investing discipline to set aside a certain amount of your income every month to investing and other stuff like that. And once you've amassed that $15,000, that's when you've probably become disciplined enough and have enough money saved in order to kind of graduate into the bigger leagues. I'm going to go into that and explain that. So the reason I said $15,000 is because $15,000 is 5% of $300,000. I think that $300,000 is really the entry level price for buying single family residence as investment to rent out. The median house price in America is around $420,000. And I think that once you start going under $300,000, it gets really speculative with some of these markets. And it's just better to go into markets that are a little more established, where the upside is still there. So it's still under what that median house price is in America, but it's not so far under that you're taking on a lot of unnecessary risk. That's just my opinion. Obviously, you'll learn what the risk profile looks like for you. So let's get into it, guys. Look at this. This is my first time doing a PowerPoint presentation with my overlay here. So safe to say we're getting pretty advanced with our videos here. So I'm going to be talking about the waterfall structure. I mentioned $15,000 earlier, but for the sake of this example, I'm going to be using a $400,000 purchase price for a property, which would put you at around $20,000 with a 5% investment. So this is my slide, Emerging Market Real Estate Investing. This is kind of like a pitch deck. Real estate opportunities presented by me. Exciting. And today's date, which is April 21st. This is the executive summary. This is just kind of goes over all the main things that we're going to cover in this little pitch deck. It is going to be a $400,000 purchase of a turnkey rental property. It doesn't have to be turnkey. I just think it's better when you don't have to do any renovations or change anything about the property, because that eats into the time that you can get it rented. So why spend a month fixing the property when you can fill it with a tenant immediately or as quickly as possible? And then I do everything pretty much on 5-year hold periods. I think it's realistic to look at markets over 5-year periods. It gets kind of hard to predict longer term. 6% target cash on cash return. So that just means 6% cash on cash of what you invested. So for a $400,000 property, that means you'll be making about $24,000 a year in net operating income. So that's pure profit cash that goes to your bank account, which is about $2,000 a month, which is pretty huge. And then a 4.5% compounding annual appreciation. So this means that on a $400,000 property, it compounds by 4.5% year over year, and that stacks. And then a low risk asset with high upside potential. There's a good amount of buzzwords there. This is the investment in capital structure. If you have $15,000, or in this case, $20,000, you are basically going to have 5% equity in this property, and you're gonna go out and you're gonna get another investor to invest the other $380,000, or the other 95%. And this is really, really good for you. And I'll explain why. We'll get into it later. So the purchase price, like we said, is $400,000. The location, I left it kind of blank here, but emerging rental market. So could be Ohio, like I talked about in one of my previous videos. This could be Taylor, Texas, like I also talked about in a previous video. This could be various other markets that I've gone over and some that I haven't gone over that I'll make videos about in the future. So you basically go to an investor and you tell them, and you don't want to guarantee them this because guarantee means you're legally obligated to get them a 6% return on their investment. And if something happens in the market, you're the one holding that bag, and that's not good. So you don't want to say guaranteed. You want to say preferred, right? So you have a 6% preferred cash on cash return. So you're going to go to an investor and you're going to tell them, hey, I think I can get you a 6% cash on cash return on the money that you've put in, which is $380,000. On top of that, I think that I can compound that wealth by 4% year over year. So your monthly NOI target, like I mentioned earlier, is going to be around $2,000 a month or $24,000 a year, which means that you buy it for $400,000 and then the exit is $500,000. So you almost make a 25% return on investment as the investor, right? But on top of that, you're making $24,000 a year. So this is rough numbers, but $24,000 a year times 5, let's just say it's $100,000, just round up. And you sell it for $500,000. So you make $200,000 as this investor off of the $400,000 roughly that you put in, which means you make 50% in 5 years, which is really, really good. That's a great incentive for an investor. And this is the minimum, by the way. I think that on some of these emerging markets that you can really get a 7% cash on cash return, and that a lot of these markets are going to grow on a 7 to 9% year over year annual compounding rate. We're going off of the assumption that the rents do not increase over the 5-year term. It's pretty realistic that maybe year 1 and 2, it's $2,000 a month, but then maybe year 3, you get a new tenant and you raise the rents by 5%. So now 3 and 4, it's 5% higher. And then maybe year 5, it happens again, you get a new tenant and raise that by 5%. But I think the best way to do this is to do all your math and operate off the assumption that it's not going to go up and everything else is kind of just like the cherry on top, right? Especially for you, and you will see why in a moment. This is where the waterfall structure comes in. So this is very exciting. The cash flow on a property is 6%, 95% goes to the investor, 5% goes to you because you have equity, but everything beyond that 6% gets split in a 70-30 split. So let's say you get 7%. That extra point, instead of them getting 95% like they typically would, and you getting 5%, they get 70% and you get 30%. And this is a win-win because it incentivizes you to do well with your job and to pick the right markets and to manage the property well. But also, they're getting extra money on top of what they already understood was their rate of return. And when you sell the property, your investor gets their capital returned, and then any remaining appreciation is again on that 70-30 split. So let's say you get an 8.5% compounded return rate. This would put the sale price of the property at around $600,000. And this is where it gets awesome. So on a $600,000 sale price, you see this little gold bar here. That is your bonus, essentially. So you get $30,000 because you just picked the right market, right? Because you get 30% instead of 5%. But you also have 5% equity in the return of capital and the preferred return. Since you have equity in the deal, you're a 5% stakeholder. So on the equity and return of capital, which in total is $498,400, on that money, so 5% of $498,400 is $24,920. So you get $24,000, really $25,000, plus your $30,000, plus this $100 a month that you get for your 5% stake. $100 a month, 12 months out of the year, 1,200 times 5, so that's $6,000. You get $6,000 plus $55,000. So you have $61,000 in profit from this structuring, right? So just to put that on a return on investment point of view, if you put $20,000 into this property, over 5 years, you end up getting $61,000. You triple your money. So this is great for your investor as well because they end up getting a 68% return on their money. Obviously, this is the ideal situation where your property grows at a higher rate than you expected, right? You shouldn't really do your math based off of this, but when the property grows at a higher rate than you expect, that's where you really make your money with this waterfall structure, right? Because you get 30% instead of 5% of every gain, every dollar that you exceed from that expected rate of return. Refinancing options, and this is putting debt on the property based off of the income. So this is leverage. We don't need to go into this too deeply. I can make a whole separate video on this if you guys want. Refinancing options, I only would ever consider after a tenant is placed in the property, right? So that when you actually have cash flow. And I would only allow for maximum of 50% loan to value. So let's say you bought your property for $400,000. I would not go more than allowing $200,000 of debt on the property. And this would require unanimous consent. So if it's me and one other partner, we would both have to agree to refinance the property in order for it to happen. If one of us agrees and one of us says no, then it's not gonna happen, right? It requires unanimous consent. And cash flow on a $400,000 property that makes roughly $2,000 a month in profit would allow for around $250,000 to $300,000 of leverage to break even. And that's at current rates. And I have a little rates chart right here that you can see, you know, how much the payment is per thousand and the different types of loans. But the reason that I don't like doing more than 50% LTV, payment per thousand is $6. So if you're gonna take out $100,000, it would be $600 a month. So if you're gonna take out $200,000, that's $1,200 a month, which puts your income, you were making $2,000 a month, but now since you put leverage and debt on this property, your cash flow is only $800 a month because you have a $1,200 mortgage payment now. The reason that I only do 50% is because if there's some sort of market correction, if the housing market goes down and things drop, I want to allow the market to drop by probably 30 to 40% and the property to still cash flow. During 2008, some areas went down by 50%. You know, some areas went down by 20%, 30%, 40%. Really highly affected areas went down by 50%, maybe even a little more. So unless we saw another 2008 like, you know, housing crash, which I don't think we will, I could eat my words, but I don't think we will, you're going to have a solid economic foundation for your cash flow model. Governance and voting. Sponsor, which is me or you, handles managing operations. So that's pretty much everything headache related. Anything would go to me, and then anything financial, like major decisions, as you can see here, like refinances, the sale. CapEx means capital expenditures. So if you need a new roof or if you want to replace the sink, things like that would require a vote. And then the protective covenants, like I mentioned earlier, no more than 50% LTV, loan to value. And then I put here no related party deals without consent. So that just means that I can't hire a plumber that is really my buddy's business and he upcharges, right? And I get the referral. So I can't do any of that stuff. The other property owner can't do any of that stuff. It just makes sure that there's transparency in the relationship because that's what it's all about. You know, when you partner up with somebody on buying a property, that is a relationship. You know, you're going to be working with this person for 5 years, right? I don't even know, like, out of the people watching, you know, how many of you guys have had like a girlfriend for 5 years, right? It really is like that. So you really want to choose your investors wisely and make sure they have faith in you. And that's pretty much it. Risk management. There's no leverage at purchase, which is good. Optional low loan to value. Again, you don't have to refinance the property, but if you want to take money out and try to make yourself whole before the sale, you can do that. And there's monthly distributions, so you get paid every month. And there's conservative underwriting in markets where there's a lot of upside. So this is what I was saying earlier. The worst case scenario with some of these, with this investment that I've lined out, is that you get average market returns, which would be a 6% cash on cash and that 4% equity growth year over year that I talked about. That's like average market returns. And in average market returns, you're still making like 50% on your investment. But if you were right, you can potentially get huge upside where the purchase price could go up from 400,000 to 600,000 or maybe even higher than that. So anyways, I just wanted to share this waterfall structure because this, as somebody with low capital, is a really, really, really good way to do things. If you guys want, I could link this maybe down below. This is the catch. You have to be so knowledgeable in these markets and these sectors that you're going to invest in. So let's say you're investing in Ohio. You can't just like pick a property and throw a dart at the wall. You might be able to, and you might do well. But the thing is that if you're realistically gonna go out and raise hundreds of thousands of dollars from people, you have to be so knowledgeable in these markets and how this process works and just real estate in general, that they have complete and utter confidence of going with you. You know, reputation is everything, right? And if you mess up on these deals, or if you are not diligent, or if you do not do your homework, you're really gonna hurt yourself in the long run. So it's really, really, really worth it to be so knowledgeable that anybody could ask you anything and you know how to answer it. If you have something like $20,000 that you can really grow your wealth in these 5 years. I mean, like I said earlier, you tripled your money. Now imagine you can do this every single year, right? So for the first 5 years, you're kind of slaving away to just get $20,000 invested in a property, get $20,000 invested. But after that, you're almost getting paid a full salary just to invest like this. You know, if you can survive those 5 years and you do it every year, you're now making $60,000 a year just from investing, right? Assuming that everything goes well and goes the way you want it to. This is also good for somebody who, let's say, has $60,000. So instead of putting all your eggs in one basket and buying a 1/5 share of a $300,000 property and you put $60,000 in, you can buy a more fractionalized share of 3 properties in 3 different markets and potentially get more upside. And the other good part about this is that it's really low risk. You know, real estate investing is one of the safest asset classes on the planet. I just wanted to go over this waterfall structure and how to invest with $15,000 or $20,000 in this instance. This video, I really just wanted to show you guys a basic way to structure this. There's obviously more nuance to this. There are other expenses, other things to keep your eye on, but you know, maybe just to open the door on how you guys can start researching this stuff on your own. So anyways, I hope you guys enjoyed the video. If you have any questions about this type of structuring, leave a comment down below and I will answer it to the best of my ability. And yeah, thanks guys for watching and have a great day. See ya.